All right, a very good afternoon, ladies and gentlemen. I'm Devang Mehra, and I welcome you to my series on WD Gann interpretations, which is basically my understanding of my interpretations of the works of the great WD Gann. And I want to start off by saying a massive thank you to all of you for the love and generosity that you've given me on the WD Gann Masterclass on my TFA channel. And it went very, very well. So I want to continue the same series with a different name called Interpretations of the Works of W.D. Gann. And today I want to start off with a very, very important and very interesting topic, or the subject matter of my discussion is how the tape fools you. This is a chapter that I've got off, or I want to knock off from The Truth of the Stock Tape, which I feel is very, very relevant. And I'll tell you why. A couple of days back, I was attending a seminar by Anthony Iser, who is ITPM's senior trading mentor. And we were talking about the tapering of the Fed's bonds through the middle of 2022 and how the cost push inflation is becoming a matter of concern, how developing and developed economies are looking forward to increasing their rates to combat inflation and all of these points. But one thing which always gets me is when Anthony Iser talked about us being retailers, us being small money. And I'll give you an example. Anyone who's involved in the markets right now, I would say majority of the people looking at this video right now, we're retailers with small money, which means that if you haven't been involved in the proprietary trading function of an investment bank or similar services, we're all small money. And we eventually don't know what we're doing. We always think a particular way, but we always go the other way. Other than the markets. So Gann was very kind enough, or was very discreet in writing something about this. And this is called the chapter number 4 from The Truth of the Stock Tape, which is called How the Tape Fools You. And I'm going to read it out to you. I have some examples that in the very recent past that I've observed and I've understood very, very well. And I personally feel if you guys are getting trapped in the markets because we are eventually small money, I think this is something that you will always fall back upon. So let's get started, guys. So I'll read it out to you. The tape is used to fool traders. For often when stocks look the weakest on the tape, they are the strongest as accumulation is taking place by the professional traders. When the stocks look that they are in a weaker position in the market, when it looks to us that when we should go short in the market, that's actually when the big money, the professional money is actually accumulating those stocks. And at the same time, when they are booming and when the stocks are very active and appear the strongest, they are really the weakest because the insiders, or the professional money in this case, are selling while everybody is enthusiastic and buying. I'll give you a very, very good example on this. I'll start off with something that I have chalked off NASDAQ. This is the charts of Wynn Resort, great casino hotel in America, and something that I feel is very, very relevant in this example, because see, all these things have universal applicability. All you need to do is find out and spend some time on the charts. You can see the charts of Wynn in the period of June 20 all the way till November 20, and you can see that the markets were really respecting these support levels. And I have a simple ruling, and I think everyone is very well aware of these things, that when the markets keep on coming down to a particular support and doesn't make higher swing highs and higher swing lows, so it starts to become weaker, the support starts to become fragile. That was what exactly was happening in the charts of Wynn. When the COVID pandemic started, hotels, the tourism and travel industry was very violently hit, very aggressively hit. And it looked like the Wynn charts were about to become fragile. And when all the hope was lost at this point of support, eventually Wynn started to go up $68 a piece, all the way to $140 a piece. And this was something like a short build-up happening on the charts. And eventually it did kind of give you a breakdown. It did kind of give you a breakdown here also, but it eventually failed. So when stocks start to look weak to us, that's exactly when things start to become bullish. That's exactly when the big money starts to buy the market. And I think a very good example on this could be the charts of Nifty, or could be the charts of any index in any country that you're from. So for example, when the markets start to plunge, I remember this point of time, everyone would talk about going short. Everyone would talk about going short because anyone who was buying in the market was getting trapped. Every single day, markets are falling 2%, 1%. And I remember the times in India This was the first time I actually observed the markets getting halt. So around 10:40 or 11 o'clock, markets would halt for half an hour, 35, 40 minutes, and then they would again resume trading. So everyone was talking about going short. All brokers were cautious, but eventually you can see some kind of consolidation happening over here. And that's exactly what even Charles Dow talks about, how the markets after a good depression or a good, I would say, recessionary time or a good crisis, how the accumulation starts before the participation starts. And people like you and me, we're small money, right? So we will always enter at this participation phase. But this is where the smart money comes. And when everyone is going short, when all of you guys are going short, when all of us are going short, that is when the big investment banks are actually accumulating. That's actually when the big insiders or the big mutual funds, the big people involved with the information, they're actually accumulating these scripts or these assets. Another example in the very recent past could be could be Nifty IT. And this is one very recent trade that you guys have taken with me. I believe everyone should have benefited from these ideas. This was the time on Nifty IT when Nifty IT lost hope eventually. It still is not, again, extremely bullish. This is because of the earnings that have come out from the first IT company in India, Q2 earnings of Tata Consultancy Services, the biggest IT company in the country. But when the markets were plunging down, when everyone started going short on the IT sector, that's exactly when the markets start to go higher again. So I hope you're getting the idea. Another flip side of this could be a chart I lost some money on. This is called Aarti Drugs. And this is an API sector company, or I would say this is in the pharmaceutical space. And I lost some good money on this stock. I'll tell you what happened. This was a chart of this. Basically, there was a very big API push going in India. This was on account of a lot of inflows of orders, I would say, from China coming back into India, and all the API companies all over spaces were going mad. And the Aarti drug stock started to consolidate at a higher end of this range. So markets were doing comfortably well, and this stock, great volumes, good earnings, everything was going fine. It started accumulating at a very, very important support, and eventually, when everyone thought the markets are going to go higher, it started to plunge down and down and down. And from that point of price, it plunged about 200 rupees a piece. So this is what happens, right? Market discounts all information. We can never be too early with small money. I know I talk about being small money a lot because I am trying to stress on the concept that markets make a fool out of us. And this is what even Gann talks about in all his books and all his readings. And if I can open that book again, the chapter is called How the Tape Fools You. So I'll tell you a very small paragraph that he's written. He said, the man who watches the tape daily is influenced by his hopes and fears. He cannot help it. So what he's trying to, what my understanding is of his work, what my understanding is of the various authorities on Gann. And in this series, I'll be reading a lot of people's work, not only WD Gann, but a lot of big authorities on WD Gann. And all of them have stressed upon this point, which is please focus on the bigger charts. Please focus on charts like 3-day charts, 1-week charts, 1-month charts, rather than use swing charts in the markets. And I think if you have learned from people who are authorities on Gann in different parts of the countries like Australia and America, you must have read about terms like swing charts, using monthly ranges, etc. So he doesn't talk about daily levels, but he talks a lot about observing the bigger picture. Because in the words of David Bowden, smaller charts are more hiccups and the bigger charts are clean. So suppose that the market has been strong all day and the very stock that you are interested in, the small money is interested in, is gradually going up. So the markets are doing fine and there's a particular stock that you like is going higher, which is basically then you're trying to get into the stock. And when suddenly around 2:30 p.m. when the markets are about to close, the market starts to break. So the stock that you went long on because the markets were doing fine, it starts to break. It goes down 15 minutes and all the active stocks are off a point from the high. So for example, let us say you bought a stock of 100 rupees. I'm talking about the Indian values. So let's say you bought something around 12 o'clock, 1 o'clock, 2 hours before the markets are closing, around 100 rupees a share. And around 2:30 p.m., everything is fine. The bigger picture is intact. The weekly charts are signaling a breakout. The weekly charts are signaling an accumulation. However, as small money, the mistake that I have made eventually, that you guys must have made as well, is we look at the tape too much. We look at the prices going on in the market at our trading screens too much. And that is what Gann said, don't do that. So we buy something at 12 o'clock and we see that 2:30 market start to break. The share that we bought 100 rupees comes down to 98 rupees a share. It goes down 15 minutes. And he said it does not rally up after that. We're expecting that from 98, it's going to cover back again to 101, but it doesn't do that. What eventually happens is around 3 o'clock, it falls more. It does not rally. And by 5 minutes to 3 or something, they are off another point. So 100 goes to 98, goes to 97. It keeps on falling and falling. And what do we guys think? Think about it. I'm looking at the screen every single day. I'm looking at my P&L every single minute. What happens? My stock falls 3 rupees a share. I think to myself, maybe it's not for me. Yes, I know the bigger charts are in my favor, but I never think about that. I think like, this is not for me. I've fallen 3 points already. And what happens? The volume is heavy and we decide that something is wrong and we sell out at the close. Why? Why? Because selling in the last half hour was simply the result of profit taking. What he is saying is when the volumes were heavy in the last half an hour and when we decide to sell out the close. Why? Because we don't want to take overnight positions. And what happens the next morning? The next morning, the stock opens up 1 point after point. That 97, 98 bucks a share is opening 100 rupees, 101 rupees. Eventually, it's in profit, but we panicked. Why? Because we're looking at the tape too much. We're looking at the screen too much. I always talk about this point to a lot of my clients is that spend more time in understanding the macros, understanding the position of the market that you're in, and cultivating an idea, and then less time on the screen while the idea works for you. So don't spend less time finding an idea and more time on the screen tracking whether that idea is going to hit your stop loss or it's going to hit your targets. So just remember that point going forward. So the next morning, the stock of 100, which plunged to 98, opens up 1 point. So let's say 101. Why? Because the selling in the last half an hour was of traders like us who were scared of, and we sold out positions at the close because we didn't want to carry them overnight. And this is the result why the supply of the stocks offered next morning was limited and the reaction had nothing to do or interfere with the main trend. The main trend was bullish. Markets give you opportunities. I'll give you a simple suggestion. If you're finding difficulty in the markets, rather than buying breakouts, try to buy supports. And this is what Gann is trying to mention, that, when the markets are coming down, don't spend too much time on the screen. That, my stock's gone down 1 point, 2 point. Have a stop loss. Gann was very specific about that, because even Gann could achieve only 92% of accuracy. So have a stop loss, have a small stop loss. If you're on my Telegram channel, I give you these ideas that I call magnet trades. So for example, a couple of days back, I would say on Friday, which was the 8th of October 2021, you can always search on the Telegram channel. I talk about this magnet trade of 17,840 levels. I said, buy Nifty 17,840, have a 3 to 4 point stop on the index spot, and we got a target over 80, 90 points. So a big accuracy. So have a stop loss, but don't keep observing that, I am 1 point, let me exit. Don't just keep panicking. One of the biggest mistakes the man makes who watches the ticker all the time is that he trades too often. And he gets in and out of the market several times during the day. And each time he's paying commission. You have to understand that we are, eventually paying a lot of money to the brokers, and the brokers earn a lot of commission through us. And the biggest problem of, trading too often is the accumulation of these commission expense at the year end. And that's what Gann talks about. If he buys or sells higher or lower each time, even though he's making profit, eventually we are increasing the percentages of trades against him. Let us say you take 10 trades in a month, your profitability accuracy will go higher because less trades may be spending more time on cultivating the idea. However, if you're trading 100 trades in a month, the percentage of trades against you will go wrong because you are trying to, find out every single top and bottom in the intraday charts, and that is going to give you more stop losses. So my idea would be, my interpretation from this would be that rather than going for every 10, 20 point on the index or whatever, a very, very small percentage on the stock that you're trading, try to find major levels, try to find major pivots in the market and try to trade off them and hold those winners for a very long period of time so that they give you big profits in a single trade. rather than doing 10 trades and achieving that same amount of profit. And eventually that won't happen, because even if that happens, we're paying commission that will set off our profits. A man who makes 300 trades in a year, or say one trade for each market day, is going to pay an average of half a point for getting in and out commission. So it cannot be done for less. That is what it is. That's how the brokers are going to operate money. They're going to make money. And then half a point, 100 shares 300 times is 150 points expenses through the year. So what I am saying is, even if you're earning, let's say 300 bucks a trade, you're actually paying 150 points for commission and expense. And I've seen a lot of these points happening. You know, we always review your weekly performances when you take up programs. And I've observed one thing: a lot of you, when you start off the journeys, you pay too much commission. So, for example, you're running 10K a week, you're probably paying 5K in commissions, 5K in brokerages, because you're entering too many orders at a particular period of time. So, I would say, please try to avoid this. A man who can make money, where is the man who can make money with such a handicap? You might do it one off, but it's not going to happen again and again. It's not going to be consistent. Suppose a man makes one trade each month or 12 trades in the year. His expenses are 6 points against the scalper expense of 150. That is what we have to think about. Scalping is fun. I'm not going to go against scalping. There are different styles. There is something we call swing trading, momentum trading, long-term investing, positional 20-60-day trading. And there's also something like scalping when you come in the market or off a couple of points, etc. But I've learned something from attending seminars from a lot of professional traders, is that when you do intraday, when you do day trading, you're actually betting against algorithmic trading and you're betting against AI trading, artificial intelligence trading. So a lot of times you will go wrong, and a lot of times when you go wrong, whether it's small stop loss, you'll eventually pay a lot of commission. I hope these things are clear. So the idea is simple: try to take trades on major pivots and give stop losses, very small stop losses, and give less commission on those trades. So give less commission at the end of the day. So even if you aren't earning a lot, your cumulative is a good figure. And I think one very, very important point to sum up today's subject matter is this. Another important fact traders are overlooking when they trade too many positions, or when they are looking at the ticker too much, when they're looking at the tape too much, what the tape fools you is that when a person is getting in and out of the market too frequently and too often, the more time he's changing his judgment. I think this is very, very important. The percentage of being wrong increases. I'll give you an example. When you come in the market, you do your homework and you decide, I want to be long. You last evening, when you decided that tomorrow morning when the market opens, I want to be long. And what happens? You go long in the market, you right, you make a good amount of money on that. But eventually, your greed comes in. You look at the markets, they're trading at a higher price, you again go short there. When the markets are trading at a higher price, you again are going short, because you want to go buy low, sell high, etc. And with these kind of views coming in, you are changing the view that you came in the market with. You came in the market that I want to be a buyer. Always remember one thing: when you come to the market, decide, do I want to make money by buying today, or do I want to make money by selling today? But a lot of people make mistakes when they get confused, when they buy low, sell high, because eventually one of those trades. So for example, you bought low and then markets went up, you went and sold high. I'll give you an example, very, very good example that I have for you guys. So what I'm trying to say is that you come to the markets and you decide, today I want to be a buyer, and markets come down to a support and you buy the support and the markets come over here. And then you get something like a shooting star on the charts. And then, we decide that, since we're at a resistance, let's go short. But that is against our plan. But that's fine, let's go short. The markets come down, we go short, and then it reverses back up, because eventually the market is buy on dip, how we had initially decided as per the bigger picture. And we take a stop loss. And when the market goes higher, that is where the problem comes in. The problem is that when the markets are now trading at these levels, now we don't want to buy, because of this one stop order of going short. Now when the markets are trading at this point of time, we think to ourselves, now the markets are too extended. We look for another resistance and then we go short again over here. Again, market will rise. Again, we'll go short. The process will continue. So the suggestion that I'm giving you is, when you are coming to the market, just make up your mind. Do you want to be a buyer today, or do you want to be a seller today? But don't just keep on doing both these things. Don't spend too much time scalping. If you're a scalper, that's great. Have a good capital allocation. What I mean by that is, if you have a 100,000 account, make sure 20-30K is in scalping, 70K isn't something like a long-term investment or a good position to trade, so that eventually your risk is spanned out. What big investors like David, Paul, etc. have said, that don't risk too much on a particular trade, so that even if the trade goes wrong, you can again come back to the market the next day. What Gann says, don't risk more than 10% of your capital on a particular trade, so that you can even come back on the trade. So that was the idea that I had in my mind. One very good example is on Voltas, which another trade that we've just taken on Thursday or Friday. You can always go back on the Telegram channel and have a look. This was a very, very simple trade. This was basically what I am covering is the point that I talk about over here. So the market overall is looking bullish, but when the markets come down after 230 or something, we start to exit our positions only to find that the next day markets are again at highs. That's what I'm talking about. And that happens when we look at the tape too much and the tape fools us. So it's a 15-minute chart, day chart. You can see how the bigger picture, actually the bigger picture right now. The bigger picture is greatly bullish. You can see a good breakout has occurred on the charts of Voltas. This company manufactures air conditioners, etc., and similar products in India. And if you open the 15-minute chart, the bigger picture is fine. It's bullish. On the 15-minute chart, what happens is on the day of 8th of October, the market starts to come down. And this is what happens because we see the markets coming down. If we were not focusing too much on intraday prices, we would not have observed that. But person who is focusing too much on the tape, you must have observed that even good volumes coming in. And what happens eventually the next day of 1280 closing opens at 1290. So that's exactly what I'm saying. Spend less time on the tape, spend less time on the screen, and I think the markets will reward you. That's all for today. This is the episode 1. I hope you enjoyed it. Some fundamental points for a retailer in the market, which I feel are very, very important, because eventually we're getting trapped every single day. We're getting crushed by the proprietary money every single day. So I hope these small points that I've discussed today, my interpretations of his work, must have been able to find your way in the market. That's all for now, guys. Hope you enjoyed. Please like, share, subscribe, and I'll see you in the next episode. Cheers, guys.